Let's Talk Accounting answers the question, what is? Removing the jargon of accounting, finance, and business. Shedding light on some of the jargon used, clarifying the jargon into everyday words you'll understand, and get a clearer view of what is happening in your world, building your confidence in the world of business. Let's get started. Next. Number 71. What is a business cycle? Throughout its life, a business cycle goes through 4 identifiable stages, known as phases: expansion, peak, contraction, and trough. During an expansion, businesses are steadily growing their production and profits, unemployment remains low, and the stock market performs well. A full business cycle on average is 4.7 years. Next. Number 72. What is preference shares? Preference shares are shares in a company that are owned by people who have the right to receive part of the company's profits before the holders of ordinary shares are paid. They also have the right to have their capital repaid if the company fails and has to close. Preference shareholders do not enjoy voting rights like common shareholders do. Next. Number 73. What is price-earning ratio? Price to earnings. P/E ratio relates a company's share price to its earnings per share. A high P/E ratio could mean a company's stock is overvalued. Basically, a P/E ratio is a way to measure how expensive a company's shares are. A higher ratio shows investors are willing to pay a higher price today because of growth expectations in the future. Next. Number 74. What is credit? Credit is the ability to borrow money or access goods or services with the understanding you'll pay later. There are 4 types of credit. 1. Revolving credit allows you to borrow up to a limit. 2. Charge cards, often mistaken to be the same as revolving credit. 3. Installment credit is repayment in installments such as hire purchase. Last but not least, 4. Non-installment credit or service credit is prepaid as a lump sum. Next. Number 75. What is privatization? Privatization is defined as the transfer of ownership rights in state-owned enterprises to the private sector. If an individual or organization purchases all the stock in a public traded company, effectively makes it now a private company. It is used to strengthen the stock market, increase efficiency, and to obtain funds. The main argument for privatization is that private companies have a profit incentive to cut costs and be more efficient. Next. Number 76. What is productivity? Productivity is defined as a ratio between the output volume and the volume of inputs. It measures how efficiently production inputs, such as labor and capital, is being used to produce a given level of output. As productivity increases, an organization can turn resources into revenues and retaining cash flows for future growth and expansion. Next. Number 77. What is a profit and loss account? A profit or loss account, sometimes called income statement, is one of the financial reports of a business, showing the money coming in and the money going out for a period of time. Could be monthly, quarterly, or yearly. Sometimes even weekly. It is the performance of buying and selling. Profit and loss has nothing to do with cash. It is performance. Increase is a profit and a decrease is a loss. Next. Number 78. What is a quote? A quote is a formal document explaining your pricing for a job or order. It is a clear cost of the work. When the customer requests a quote, it means they may do business with you. A quote should include: 1. Your business details. 2. A total breakdown of costs. 3. Any variations and revision rules. A quote is not a binding contract until the offer is accepted. Next. Number 79. What is rate of return? A rate of return, sometimes expressed as ROR, it is the net gain or loss of an investment over a specified time period. Expressed as a % of the initial cost of the investment. You are looking at the % of change from one period to another. Calculated as the current value less the original value divided by the initial value times 100. This expresses the rate of return as a percentage. Next. Number 80. What is ratio analysis? It is a useful management tool to improve your understanding of the financial results and trends over time, providing key indicators of the business performance. Managers can use ratio analysis to pinpoint strengths and weakness within the business. For example, profitability ratios. 1. Gross profit ratio equals gross profit divided by net sales times 100. 2. Operating cost ratio equals operating cost divided by net sales times 100. 3. Operating profit ratio equals operating profit divided by net sales times 100. 4. Net profit ratio equals net profit divided by net sales times 100. Next. Number 81. What is real interest rate? Real interest rate is the rate of interest an investor, saver or lender receives after allowing for inflation. Approximately the nominal interest rate minus the inflation rate. For example, when interest rates rise, business and consumers will cut back on spending. This will cause earnings and stock prices to drop. When interest rates drop, business and consumers will increase spending, causing stock prices to rise. Next. Number 82. What is real return? Real rate of return is what is earned on an investment after accounting for taxes and inflation. Real returns are lower than nominal returns, which don't subtract taxes and inflation. The real rate of return formula is 1 plus nominal rate divided by 1 plus inflation rate minus 1. A nominal interest rate is the interest rate before taking inflation into account.
If you don't know what you're doing, it's a jungle out there.
This completes the chapter. Watch this space for the next chapter of Let's Talk Accounting.